Welcome everyone to Macro Matters. This is our conversation when we hit on the macro issues that matters for our members at CFA Society Chicago. My name is Lotta Moberg. I am at William Blair with the Dynamic Allocation Strategies team. Today is April 7th, 2022, and I have with me Tony Zhang and Rich Excell, which are both of the Geese School of Business. Welcome, guys.
Hi, Lotta. Hi, Tony. How are you guys doing today?
Hi, Lotta. Rich, haven't talked for quite a while. I'm missing the talk.
It's been a while. You're right.
Lots of travel. We've had some illnesses, all kinds of things that life brings you. We want to talk about today Fed policy, yield curves, and particularly there has been a lot of talk lately about inversion of yield curve. It's not only a matter of what does an inversion of yield curve mean, there is also the question of, is there an inversion? And if you believe that there might be an inversion, what are you even supposed to look at to interpret the data? There are a lot of data here. There's not just one curve out there. So I want to ask our experts here of all of this on all of these topics. And Rich, I'll turn it over to you right away to just give a color of what are the actual expectations? What is driving this talk about yield curve inversion? In particular, are there expectations out there about higher rates in the shorter term, or is it the lower rates in the longer term? So and maybe we should make sure also that we're all on the same page what we mean by a yield curve, what we want to look at here. We are in the US. We're going to be biased towards data, focusing on the US. That's where we have a lot of data and most intuition. So why don't you take it from here and give us a kind of the overview of what is happening here and how to interpret this talk about yield curve inversion.
Sure. Thanks, Lotta. So I think when we think about what we want to think about when we talk about the yield curve is that there's a different cost of money at different time periods over time, right? And so if we look at it, we know that from finance, and kind of a basic rule that we all know of, is that the longer we lock up our money, the more we should get paid in theory, right? That's what we would call a term premium. And so therefore there should be a different cost over time. And typically that cost should go higher over time if we're actually locking it up. We're not going to get into the whole idea of term premium and why that might not be the case anymore. But for essentially, we can understand then that there's a different cost of money and that this cost should go up over time. And therefore, the yield curve is typically upward sloping, right? And we normally talk about it being steep in, quote, normal times. And so when this curve starts to flatten out, we have to ask ourselves, what's really going on? So what's the market saying? What's the impact? And what's really driving it? So if I can first talk about what's the market kind of saying is there's a couple different interpretations to this yield curve. And so when you really think about a 10-year yield, you're ultimately saying that this is essentially an accumulation of where the Fed funds rate is going to be each year for the next 10 years, right? And so what the market's saying is if we look at, for instance, the most common portion or quoted portion of the yield curve being the ratio of the 2-year yield versus the 10-year yield. And the reason that's chosen is simply because those are the two most liquid futures contracts, not for any other particular reason that I can kind of find. You would look at the cost of money in 2 years and the cost of money in 10 years. And you look at those, and what they're saying then, if that curve is flat, the cost of money being in 2 years and 10 years being the same, that's saying that the market doesn't think that the Fed funds rate is really going to change at all between 2 years and 10 years. That's one way to kind of think about this. Another way to think about this is that we know what drives economies. It's the cost of money. It's banks creating credit in the economy. So why do banks create credit? Well, banks usually borrow short and lend long. And so if they can lend long at a higher rate, they can make money. That's their net interest margins. And so if they're lending in a steep curve where they're making more money when they lend versus what it costs them to borrow, they have more of an incentive to lend or to create credit in the economy. And when that cost, when the rates become much more narrow, then there's the net interest margins of banks are reduced, and therefore they have less incentive to lend to the economy, and therefore credit creation shrinks, and therefore the economy may in fact shrink. And so there's a couple different things that are going on with that. But what's really driving it? If you don't mind, I'm going to share my screen really quickly and kind of show you something that may sound really busy and wonky in first place, but I think ultimately the logic of this is pretty easy to understand. So what I'm looking at here is my calculation of what the market is pricing in for the number of central bank Fed rate hikes in the next year. So what I do is I look at the fourth contract of the euro dollar futures. And when I say euro dollars, I don't mean the FX rate, euros versus dollars. I mean the interest rate product, the euro dollar futures, which is itself a 3-month a future on a 3-month contract. And so really what we're looking at here, and the euro dollars are quarterly, is where the market thinks short-term interest rates will be in 15 months from now. Okay, so I take that, I can back out an interest rate from that, because the way they're quoted is 100 minus the euro dollar future is the interest rate. I discount or take out the federal funds rate from that, and then I divide it by 25 basis points, because typically the Fed raises rates 25 basis points at a time. Now we can talk about whether or not that'll be 25 or 50, et cetera, but let's just assume for the purposes of this graph that it's 25 basis points. So by looking at that formula, I can see that right now the market is pricing in a little over 10 rate hikes over the next 15 months. And in and of itself, that's a big number, but I think we can also look at this chart and see how much that has changed just in the last 6 months. So if we go back to September, we can see that there was almost 0 rate hikes priced in, less than 1 rate hike priced in through September. By December, we were a little over 2 rate hikes priced in, okay? And then if we go into the period in middle of February, we got up to 6 rate hikes. And that's really when the market started to wobble quite a bit. Of course, there's other things going on in the world, but because of all the wobbles that were going on in the market, the number of rate hikes priced in backed off. It came back down to about 5 by early March. But what's happened over the course of the last month or so is that an incremental 5 rate hikes have been priced into the market over the next 15 months. It's a combination of the data that we're getting. It's the combination of the commentary from the Fed, from not just Jay Powell, but from other members of the FOMC. In fact, today, here we are on April 7th, and James Bullard, who's known to be very, very hawkish, said that he thinks that the Fed shouldn't stop until the Fed funds rate is 3.5%. For comparison, this fourth Eurodollar contract that I'm looking at is pricing in the rates in about 15 months to be about 3.16%. So it's not even as hawkish as James Bullard is. But the market might discount that because, again, he's quite hawkish. And so that's really what's driving the yield curve, is not that the 10-year yield has gone down in yield. It's actually gone up in yield. Is that the 2-year yield has gone up considerably faster than the price of the 10-year yield. And that's what's caused, perhaps it hasn't caused, but that's in nominal yields, at least, that's what's caused this flattening and inversion. But I think maybe Tony's got a better idea about what's really the market impact of that sort of inversion.
Yeah, Rich, you actually pointed out a very interesting point, because traditionally, based on the market wisdom, that whenever we saw yield curve inversion, it tend to actually indicate the possibility of recession in the economy. However, this time it turned out to be a little bit different from what we have seen over the past few times, because as what you mentioned, the 10 years yield increase, but it just at a slower pace than the 2 years yield as what we have seen. Now, this is why actually the market did not respond dramatically over this yield curve inversion. Well, if that's the case, that sometimes yield curve inversion would point out really the possibility of reaction. But market tend not to agree with this. I guess there might be a lot of fundamental reason that could be explained right here, because from the labor participation rate and from the job unemployment rate, we continue to see the job participation rate continue to go higher and unemployment rate continue to go slower, which actually telling me that we have a very strong economy at the U.S. That's why the 10 years yield actually goes higher rather than actually pointing to at least not below 0, not a nominal rate, right? And what here, the yield curve inversion is really caused by the market's reaction to the Federal policy over the rest of the year. As what you actually point out, that's a very interesting thing, that how many times the Federal or the central bank might hike the interest rate this year will become a major driver for the market volatility. Now, the market would say there might be a chance in the May meeting that the chance for the 50 basis point high will be extremely high. Right now, I guess probably that's the market expectation. But what left unexpected is, well, will they continue to hike another 50 basis point in June or in December? That's a question mark for the market. And most of the time that, especially over the past 2 weeks, we have seen multiple sectors, even including the defensive sectors such as healthcare, utility, which tend actually not to have a too high correlation with the market movement, like S&P 500, also show up a very high market movement correlation. That indicated the whole market actually is really driven by the macro factor. Just here, apparently, it's the Fed policies over the next 6 months. I think the market would watch out this very, very closely.
So this
What do you
is
think, Lotta?
yeah. Well, what you're saying, if I may interpret it, is part of this reflation kind of narrative that you can have inflation, high inflation, and high growth at the same time, and it's the growth, as you're saying, that drives the higher rates, as opposed to higher rates being driven by external factors, in this case, presumably central banks, that then would decrease growth, and you would have that reaction. Now, we do see negative market reaction when we get hawkish statements. So in that way, it's not 100%, in my mind, reflation trade, because if otherwise, like, the market could be interpreting any hawkish statements where they often say, well, the economy can bear it, in a positive light. Yes, the market can bear it, and we're going to have a better environment because we should get inflation down if they increase rates. And we're still believing that the growth can be sustained because it's strong. It's strong enough to sustain itself in the face of high yields. So that seems to be kind of what you're saying here.
Lotta, you definitely raised a good point over here, is whether the growth rate would outpace the concern raised by the inflation. I think this is something that what we definitely can see from the quarterly earnings report very soon. I think over the next few weeks, or 1 month, once the corporates, especially those S&P corporates, report their earnings, we should see whether they can keep the pace or with the strong momentum. And in my opinion, that tends to be still the case.
One thing I might add to that, what you're talking about, is that it's really interesting to know whether or not the market's worried about growth or inflation, because I think in my mind, whether it's worried about growth or inflation dictates ultimately whether or not bond prices and stock prices are going to be positively or negatively correlated. Historically, when the market's concerned about growth, bonds and stocks are negatively correlated, because as growth concerns creep in, stocks might sell off, but then the expectation is that central banks will lower rates, bond prices move higher, and that negative correlation softens or reduces the risk in portfolios. That's why we see the standard 60-40 portfolio. That's why we see risk parity type portfolios, et cetera. But to your point, Lotta, if the market is worried about inflation and stocks and bonds become positively correlated, so higher rates means lower stock prices, then a lot of these portfolios that are designed to have stocks and bonds in them to reduce the risk of each other actually become more risky and not less risky.
And which scenario do you believe in? We are in right now, Rich.
I think the inflation is going to be permanently higher. Maybe not 8% higher, but I think the inflation is going to be a lot higher than the Federal Reserve thinks. And I'm skeptical that they're going to be able to act or be willing to act as much as they need to in order to slow that. And the reason I say that is I think there's a lot of structural reasons why these commodity prices, which are driving a lot of this inflation, won't naturally come down, because normally the cure for high prices is high prices, because supply ultimately comes on. But there's a number of structural limitations, not the least of which is, of course, the troubles that we see in Russia and Ukraine. But there's other structural reasons why a lot of these commodities might not be seeing supply come back into the market. And so I think there's this natural expectation that it will. And unfortunately, the problem with inflation, which is also the problem with deflation for that matter, is that at some point it becomes a mindset. And as consumers start to expect prices to be higher in the future, it changes their behavior, changes their consumption behavior, but it also changes their expectations on what they want to get paid to go back to work. And I think we're already seeing some evidence of that creeping in to a lot of the articles you read about whether or not people want to actually return to work or how much money you have to pay them to get them to come back to work. So I think it's starting to creep into consumers' mindsets, and that's a dangerous place.
It sounds like we're gearing up for another inflation conversation, maybe for the next call. I would like to propose that we take one step back and get back to a few things that you hit on before, Rich, having to do what is actually the inversion question here. Because one thing that I do want us to clarify is what yield curve matters. We talk about the yield curve, we implicitly mean a nominal curve, meaning the bond that you would express. There is another kind of bond out there, the TIPS in the US, which is linked to inflation. It's supposed to control for inflation. And with inflation, by that contract, means the CPI, this index that is the established index. So that not the inflation again that everybody experiences, as we touched on before. But so there are these two things. And this time, the curves look different, right? It's usually the case that if you get an inversion on the nominal, we also have an inversion on the real side. Now it is looking different, and I know that you have some insights in that, Rich. I want to make sure that we hit on this because there are good reasons to believe that that it should always, everything that hits the real economy should be a real variable, meaning controlled for inflation. But there are two different sides of this, right? So, and a reason why some people are saying now that, hey, this is actually not an actual inversion because the real curve is not inverted, is that the reason it's inverted is because inflation is expected to come down. Everything is fine. There's no recession coming. What's expected here to happen is that central banks increase, and this creates the Fed, increases the rate, and the inflation comes down. And that is good because right now there's a lot of stressors as well as a lot of uncertainty because inflation comes down. So it's actually a benign scenario. Often it's a negative scenario, but that's just because the real curve tends to be inverted along with the nominal. So explain to us your illustration as well as
well, it's my illustration, but I think you're doing a great job of explaining, so I don't want to stop you there. But I'll just tell you that the two yield curves that we have here are the nominal and the real yield curves that you talked about before. The yield curve that looks at the 2-year TIPS yields versus the 10-year TIPS yields is in white. And the nominal yield curve that we've been talking about is the one that's in orange, and that comes directly out of the futures prices in the market. Now you'll see that it looks a little noisier, et cetera, in the white in the one that uses the TIPS. The TIPS market is a lot less liquid, and so you do get a lot more variability in the prices and the signaling there. But as you can see, exactly to your point, the trends between the two, and we only have data going back to 2005 because that's when the TIPS market in the US started. But the trends between the two always look very, very similar, but we're seeing a very different picture in what's going on in these two different yield curves right now. And I think that's particularly important and worth mentioning and pointing out because the Fed has really been trying to act, particularly since 2020 and COVID, via the real rate channel and driving real rates negative to force investor behavior to take on more risk. Is that how you're interpreting it, Lotta?
That is in line with how I'm thinking about it, but I'm actually not sure. Maybe we can get Tony's view on this as well.
Yes, apparently over the past 2 years, apparently the Federal Center Bank really drive the market movement. They really provide lots of liquidity to the market so that the investor will remain like a risk on or very optimistic about the future. I think that's aligned with what Richard has shown here.
Mm-hmm.
I might suggest that there's another question about when we talk about yield curves, and it's not just the nominal versus yield or nominal versus real, but it's whether or not the 2-year versus 10-year is the appropriate yield curve to talk about. And there's another slide that I have here, which looks over the last 45 or 50 years or so, and it looks at the green yield curve is the 2-year 10-year, and that's the one, like I said, we've had the longest history with. I have red shades there, which indicate the recession periods. And I have a white horizontal line that indicates approximately the zero level or when the curve is inverted. And you can see that every time that this curve, the 2-year, 10-year yield curve, going back all the way to the 70s, has inverted, we've seen a recession. Now it's been a perfect signal in the sense that every time it's happened, we've gotten a recession. Now, if you're a quant investor like someone like Tony, you would probably point out that while it happens every time the yield curve inverts, it happens with long and variable lags. And so it's not necessarily a signal that you would use to invest on, but it is kind of a warning sign that was something we might want to bear in mind. But what I find really interesting is that increasingly more and more people, whether it's in the articles or the pundits or other investors you speak to, they also talk about the 5-year, 30-year, which doesn't have nearly as much history. And I think even in the Fed research, we see much more reference to shorter term yield curves, such as the 3-month 10-year, which is the one in blue, which, given my background investing in financial stocks, we always looked at the 3-month 10-year, the 3-month 5-year, because that yield curve actually much more closely resembles the net interest margins that the banks have, because they're essentially borrowing via deposits, which is a very short-term interest. It's not a 2-year rate. And the duration of their portfolios oftentimes is actually quite a bit less than 10 years. It's closer to 5 years. And so you're seeing that from a bank standpoint. Remember, one of the first things I talked about with yield curves is that would bank net interest margins be shrinking in them not having the incentive to lend? Well, in that blue 3-month 10-year line, it's actually been steepening, much like that real yield curve in the last slide, which means that the banks still do have an incentive to lend. But that's just kind of how I'm looking at it. I don't know how you, Lotta, or you, Tony, are looking at the different yield curves.
I would clarify that what we're looking at here when we're saying the curve, we looked at some real curve before. This is all nominal.
This is all nominal. You're absolutely right.
Or you had a diversion which looks similar to this because it was one that was real and one was nominal. Here, they're all nominal. And the reason why they're looking different is that you're looking at different points comparison on the yield curve here. So that's just one clarification. And related to what you said, Rich, and I'm happy to turn it over to Tony too, but I want to throw this out there too. Like, if we're talking about, is this a predictor of a recession? Should it not be, one might think, that the curve and the spread of interest should be something much shorter and nothing about the 30-year, because 30-year, that should be a prediction of a recession coming in 30 years. Should it not be that it's the 3-month versus, say, the 2-year, or maybe the 1-year, or maybe even the 6 months? And that's the spread that we look at, because that would suggest the expectation of a more imminent decrease in rates, which would be the Fed's reaction to recession scare. So I want to throw that out there. I'll see who wants to pick up the baton after this.
Yeah, Lotta, I think you're right. From a quant investor perspective, they tend to look at like 2 to 10, and also like a 3 months to 10. This is two major factors that quant investor would typically look like. As suggested by Richard just saying, if we look at historically, say every time when we actually saw a yield curve inversion from the 2 to 10 or 3 months to 10, that typically will indicate over the next 6 months to 9 months, there will be a high possibility that we're going to see a recession. Well, right now we do see actually the yield curve inversion as what we just discussed right now. That from that point of view, is from a quant investor perspective, is actually if that's the case, has market fully discounted this scenario right now in the market price? Well, we do see that the market actually went down a little bit once the Federal released their Fed meeting, and simultaneously 1 day ago that the hawkish remark from one of the central bank governor, that market went down 2% and another 1% the other day. However, from this point of view, if we do see a recession, typically market, for instance, back to year 2008, that actually the drawdown, the maximum drawdown, it will be in a much larger scale than what we have seen right now. Well, market participants, they could argue that, well, lots of those kind of risk related assets, such as the stock with grossly priced metrics, such as the stock holding within the ARK has actually gone down significantly from their peak. Some stocks might have gone down like 50% to 60%. That's what we have seen over there. But if you look at the overall index, S&P 500 index, this is actually the maximum drawdown is still well above the recession that could actually cause down. So from now on here, as what we had discussed right at the beginning of this for the macro matters section, we continue to suggest that the investors should take a very cautious position right here at the moment. And especially right now, all of the indicators from the quant perspective actually tend to point to more of a bearish view rather than a bullish view. I think that's something that we should be aware at the moment. As what Rich always say, that we should be wary, right? Be vigilant.
We have to stay vigilant. I think you're absolutely right. I think one of the things that we want to look at, I don't have the chart here, unfortunately, but if we look at the yield curve and take your pick, whether it's 3-month tenure or 2-year tenure, it has also some leading properties over the VIX index, the MOVE index, which is the Treasury market volatility index, as well as credit spreads. And so, but the signal on those markets is not when the curve inverts, it's when the curve starts to re-steepen. That's when you want to start to get wary. And you can kind of see that in this graph. The recessions happen not immediately when it inverts, but to Tony's point, 6, 9, maybe even 12 months later, but it actually happens after the curve starts to re-steepen, because what that's telling you is that the market's starting to understand that the Fed policy may have gone too far.
And is that re-steepening does that tend to be a function of longer yields going up or shorter yields going down?
It's typically a function of shorter yields coming lower because the market thinks too many hikes are priced in.
Right. So there are kind of two schools here. We touched on both of them, and I was probably sloppy in assuming there's only one out there, which is one is that the reason why you get an inversion is there's an expectation of lower rates in the future. And that would suggest that we would never look at 30-year or anything like that as the spread, because it should be shorter term. But there are two reasons to believe that that is not the right theory, and that's the more the credit and liquidity theory that is the correct one, right? Which is, one, why we get an inversion is not because the longer term rates are coming down. It tends to be the shorter terms coming up more than the longer term, and the long term tends to be pretty steady. If it was simply a story of, hey, it seems to me that they're going to have to cut rates soon, then we should have the opposite, right? Longer term should be going down and wouldn't necessarily be led by the short terms coming up. And the second reason would be simply the graph that we're looking at here, saying that it's not perfect, but it's not 30 years before a recession. It's pretty narrow in terms of in time here, which suggests that the lever here, it is not the long rate at all. That's kind of a steady variable, and it's this short rate going up and down, suggesting that we have different credit conditions out there, liquidity in the market, and so on.
I would agree with you. I would say that, and I might get a lot of negative comments on YouTube for saying this, but I think the 5-year, 30-year yield is really kind of a data mining exercise where people just want to promote a certain narrative, because I think if we look back in its short history, it doesn't have nearly the same efficacy as the other parts of the yield curve do. But the reason people would argue for using that right now is because there's so much central bank activity in the 10-year portion of the yield curve that you might not be getting accurate signaling, and so they want to pick a portion of the yield curve that doesn't, that one part that has central bank interaction and one that kind of goes beyond that. But I think that might be a little bit of data mining myself.
Yes, Lotta and Rich, I think both of your remarks are excellent. I just provided a little bit comments right here. And apparently when we talk about the yield curve inversion, and typically there's a traditional believing that the 10-year curve actually is driving by the market force, while the shortened yield curve is actually more of driven by the central bank right here, which I tend to believe still the case, especially at this moment, right? Now, if we look at recently that why the central bank is becoming so hawkish, I mean, it's really, they try to show up their determination to quell the inflation, the rampant inflation right here. But what are the ingredients in the rampant inflation? Now, apparently one thing is from the energy, right? The energy price is still remaining very, very high. Well, the supply and demand curve apparently becoming driving factors over there from the supply side. Well, apparently the relocation crisis will still be there. Whether the war between the Ukraine and Russia over there, when will that be over? Still an unknown. And there could be a lot of issue with supply chain right over there. I don't see that how it could actually improve recently from that ingredient. And second ingredient will still be the wage. As what Richard just pointed out, we continue to see the hiring wage for the employers actually to try to get the employee back to work. This is still the case. So all of the drivers for behind the inflation still remain quite active. I think it's quite a very tough job for Federal Reserve or central bank to do over the next 6 months. Actually, quite difficult decision here.
I think one thing to Tony's point that we want to think about is that one of the tools in the toolkit of the Fed or any central bank that we don't really think about too much is their communication strategy. And the Fed is really understands that inflation and deflation is a mindset, right? So think back to when there was a risk of deflation, and that wasn't too long ago. And Jay Powell famously said, we're not even thinking about raising interest rates, kind of getting the people the idea that the Fed has their back and they shouldn't worry about any sort of deflation they might be creeping in. I think you're seeing the opposite of that at this point. You're seeing all of the central bank officials trying to talk consumers out of the fact that there's going to have this permanent inflation, and they're trying to be really aggressive at jawboning it, the inflation or the consumer mindset lower, with the idea that it won't change consumer behavior. But my sense is they might be a little bit late on that.
But you do think that there's an effectiveness in what we would call that open mouth operations?
Yes, I do. Well, do I think there's an effectiveness in it? I think that they think there's an effectiveness in it.
I like the term open mouth operation. I like that.
Okay, as we wrap up here, any last thoughts? Maybe Tony, if you would start, just also just hit on what to look at next here. What are we looking for next? If we are in the weeds of an actual inversion, if it is the nominal curve, then we are in that spot where we usually get a recession. Is it merely a point of looking at when the shorter rate starts creeping up? It starts creeping down, so that you are not in the negative yield slope swamp anymore? Or what else can we look for clues here, and anything else that you would want to wrap up with it?
Yeah, the financial direction will still remain the same. I think investors this year should take a still quite defensive strategy than being a more offensive one, as inflation has suggested and what had been double confirmed from the step taken by the central bank. I think the market can not agree with this, and I think the investor should be more wary about the potential consequence from this yield curve inversion.
Rich, any last thoughts?
One thing I would add is one of the things I tell my students all the time, and they'll get sick of hearing it, but so the analogy I would give is we never know when a forest fire is going to start. We never know when a gender reveal party is going to have a spark and all of a sudden half of California is going to burn down. But what we do know is that we do know when there's the conditions that a forest fire could start, right? We know when there's a drought. We know when there's been bad forest management, et cetera. Well, how are the markets similar? Well, we know that problems and stresses in the market happen when there's a drought, when there's liquidity draining out of the market. Right now, you would say that the liquidity is coming out of the market. How fast that is, we don't know yet. We know what the market's pricing in, but we'll see how fast the liquidity is coming out. But there's starting to be drought-like conditions. Is there a lot of bad forest management? Well, there's been lots of misallocated capital, I think, throughout the last couple of years. I think that's pretty safe to say. And so we've got the conditions for a forest fire out there. Do we know if there's going to be a spark or not that are actually going to light it on fire? No, we don't. We have no idea. But we do know that the conditions are ripe for a forest fire. And so people should take the necessary precautions that a forest fire in their portfolio could happen. And that's what I would encourage people to look to do.
Yeah, thank you so much. And I would definitely say that part of bad forest management is never ever allowing any little fire ever to emerge, which certainly sets you up for that conditions that you're talking about that we should all be vigilant about right now.
Absolutely.
Okay, thank you so much for joining me this week.
Thank you,
Thanks.
Lotta. Thank you, Rich.
Thanks, Tony. Thanks a lot. Good seeing you again.
You
Yeah,
too.
good.
Bye-bye.